How to invest $20 and make $5,000 in a month. Do you want to learn how to turn just $20 a week into a potential $5,000 a month? Sounds too good to be true, right? Well, today I'm excited to share with you a simple yet powerful strategy that can help you turn just $20 into a potential $5,000 a month. It's simpler than you think, and it all starts with a strategy most investors keep a secret. I'll break it down step by step, using a little-known technique that could turn your small investment into a huge payoff. Here's the deal. We're starting with just $20 a week. Yep, you heard me right, just $20. That's around $100 a month, or $1,200 a year. It's a small amount, but with the right strategy, it could grow into something massive. And the key to making that happen, it's something called the DRIP strategy, which is Dividend Reinvestment Plan. What is DRIP, and how does it work? Think of DRIP like planting a tree. You start with a small seed, which is your initial investment, and over time, it grows into something bigger. The magic happens when your dividends get reinvested to buy more shares, which then generate even more dividends. Here's how it works. Let's say you own shares in a company that pays dividends. Instead of taking that money as cash, you reinvest it to buy more shares. Those new shares will pay their own dividends, and guess what? You reinvest those too. Over time, your investment grows exponentially, thanks to the power of compound interest. Example of how DRIP grows your investment. Let's break it down with an example. Imagine you own 100 shares of a stock that's worth $20 each. The stock pays a $1 dividend per share every year. So, at the end of the first year, you'd get $100 in dividends. Instead of cashing it out, you reinvest that money to buy 5 more shares. Now you've got 105 shares. The next year, you'll get $105 in dividends, more shares, more dividends. The cycle continues, and your investment grows faster and faster. The power of dollar cost averaging. Another great thing about DRIP is dollar cost averaging. Instead of trying to time the market buying, when prices are low and selling when they're high, you just invest regularly, no matter what. So, some months you'll buy more shares if the price is low, and other months, you'll buy fewer shares if the price is high. But over time, this evens out the cost, making your investment less vulnerable to market fluctuations. The best part, DRIP is automatic. Once you set it up with your broker, it takes care of everything for you. No more manually buying stocks or trying to time the market. It's all automated, so you can just focus on your long-term goals. Choosing the right stocks. Now, let's talk about how we can make that $20 work even harder. By committing to $20 a week, you're accelerating the pace at which you buy more shares. That means you're going to benefit from compounding faster. The more shares you buy, the quicker your dividends start generating more dividends. Of course, not all stocks are created equal. To make the most out of your DRIP strategy, you need to choose the right stocks. I focus on 4 main types of stocks to build my portfolio. Blue chip dividend stocks. These are big, reliable companies that have been around 4 years, like Coca-Cola, Johnson & Johnson, and Procter & Gamble. Dividend aristocrats. These companies have been raising their dividends for at least 25 years, like AT&T, ExxonMobil, and Walmart. High-yield dividend stocks. These stocks pay higher than average dividends, such as Realty Income or Verizon. Growth-oriented dividend stocks. Companies with strong growth potential that also pay dividends, like Microsoft, Apple, and Visa. By combining these types of stocks, you're setting yourself up for steady growth and regular dividends. Blue chip stocks provide stability. Aristocrats keep the dividends coming. High-yield stocks give you more income. And growth stocks let your money appreciate over time. Together, they form a solid base for your DRIP strategy. 5 stocks to get you started. Now, here's the fun part. I've picked 5 stocks that fit this strategy. NextEra Energy minus 2.7% yield, 10.98% dividend growth, 11.98% share price growth. Starbucks minus 3.01% yield, 16.89% dividend growth, 7% share price growth. Abbott Laboratories minus 2.10% yield, 11.40% dividend growth, 10.31% share price growth. Home Depot minus 2.59% yield, 17.59% dividend growth, 16% share price growth. ProShares S&P 500 Dividend Aristocrats ETF 2.04% yield, 20.48% dividend growth, 8.17% share price growth. These stocks cover all the bases: stability, growth, and solid dividends. Now let's see how they can turn that $20 per week into a serious portfolio. So, what happens when you invest $20 a week into this portfolio? Let's see the numbers. After 1 year, your investment could grow to $2,560 after 10 years. $27,832. But here's where it gets exciting. After 20 years, you're looking at $145,504. Fast forward another 10 years, and in 30 years, your investment could be worth over $832,000. And guess what? You'll be pulling in around $63,900 in dividends every year. That's about $5,283 per month. How DRIP can help you retire. How DRIP can help you retire. So, what does all this mean for you? If you stick to the plan, your initial $20 per week could grow into a portfolio worth over $800,000, paying you more than $5,000 every month. That's passive income that could change your life, especially when you're ready to retire. Remember, the key to success is consistency. With DRIP, small weekly investments can lead to massive growth over time. So, grab that $20, set up your DRIP, and let the magic of compound interest and dollar cost averaging work for you. The journey to financial freedom starts with one small step. Thanks for watching. Please like, share and subscribe to our channel for more investment advice.